Good afternoon. My name's Winfred Mupakasi Sirumbwe, your lecturer for this session. In the previous slide, on previous lecture, we were looking at an accounting standard number 16, PPE, property, plant, and equipment. So now, before we begin to look at some practical exam question that relate to property, plant, and equipment, it's important for us to look at the IAS 40 investment property, because normal examiners, they will use a question that will have both questions that are talking about IAS 16 property, plant, and equipment, and also that is looking at the IAS 40 investment property. So let us look at on both accounting standards, and then we begin to look for more technical question. So I'm saying an investment property is land or building or part of the building or both, held by owner or by lessee for capital appreciation, rentals, or for both. Meaning, it can just be a bare land, or it can just be a house, or it can just be any property which is held, provided the purpose for holding or for buying that is to keep it so that it appreciates in value, and then you sell it. Or you have built a house, a property like the way Mandayu Arcades, like for you in Osaka, this complex, these malls, whereby the purpose is for you to lease it out to tenants so they can give you rentals, then that qualifies to be what? An investment property. If provided you're not using it as an office, you're not using it at your hotel, you're not using it as a restaurant, you're not using it as where you stay. No. As long as it is being used for the purpose of you reselling it after gaining in value, then that qualifies to be an investment property. Now, here the thing is that if you work for real estate, your job is to build a house and resell. That does not fall under IAS 40 because it becomes the inventory. If you buy a house and resell, you buy a house and tomorrow resell, that does not qualify to be an investment property, because that is, you are doing it in an ordinary business. If you work for Toyota Zambia and then you have motor vehicles that you've stocked there, you are buying and selling them, that does not fall under IAS 40 because those are inventories. You are selling them, you are buying them for the sale. But as long as you are building so that it can stay, either you lease it out to either a operating lease or finance lease, then that falls under investment property. Let me explain a bit about the lease. When you lease a property, operating lease is whereby the one who is leasing it out will still remain in control, will still be servicing that property, will still be doing the maintenance cost. That is operating lease. But the finance lease is whereby the one who has leased it out, at the end of the tenure, will have the right to buy an asset and also will be incurring the cost of maintenance. So if the property is falling under both or either of this lease, then it is accounted for under it is an investment property. But the moment it is declared it is leased out, then the lease, if lease 16 leases now applies. That's how it operates. That's how it is. So if you are building a house for the purpose of leasing it out, it is accounted for under investment. But the moment it is leased out, then the lease, if lease 16 applies. We'll explain further. Now we're saying the examples are land held for long-term capital appreciation rather than for short-term sale in the ordinary course of business. I've explained that if you're buying land, you resell. Buying land, you resell. That does not fall under investment property. But if you're buying land, you want to maintain it, and when it gains value, you sell, then it falls under IAS 40. Land held for current and determined future use. You've bought a land. You haven't even determined how you're going to use it. As far as accounting is concerned, that should fall under IAS 40 until the time when you make a decision on how to use it. The land that is regarded as held for capital appreciation, we explained, building owned by the entity or right of use asset relating to building held by the entity and leased out under one or more operating lease. I've explained if you built a house with an intention of leasing it out, that becomes an investment property. A building that is vacant but is held to be leased out under one or more operating lease. You've built a house, you've built a building, a property is still vacant, but with the intention of leasing it out, it falls under investment property. So you must be careful. Sometimes examiner will begin a question whereby the first introductory paragraph, it will be coming as an investment property, but as the question goes on further, you find that no, actually this property was leased out. So the moment you hear that it was leased out, then you know that it has ceased to be what? An investment property. Is now under other accounting standard. So it does not apply to property held for sale in an ordinary course of business. I've explained if that is your nature of business of buying property and selling, then that's not an investment property. It's used for production or supply of goods. Even if you build, no matter how big your complex is, but if all of it will be occupied as offices, then that's not an investment property. It's used for production. If you buy, you build a very big complex and all of you make it at a store. The other part is a restaurant. The other part you are selling hardware. That's not an investment property because it's being used under for production of goods and services. So that one you account it under IAS 16. It is property, plant, and equipment. Now, how do you recognize an investment property? Number one, you recognize an investment property if you are sure, probable that the economical benefit associated with an asset will flow to the entity, meaning you are very sure that the company will benefit. There are some economical benefit, there are some funds that will come to the company from this building, then you recognize it. You don't just pick any building that is not useful, where you are not probable that the company will gain something. Now, the cost of investment property can be measured reliably, meaning you must know how much it costs to build that house. You know exactly how much you've spent to build that house. You know exactly how much you spent to buy that asset. So all that cost, that's what you recognize. Now, initial measurement, we are saying, now you've just built an asset. Now you've just bought this investment property. How should you record in the books of account? What value or what figure should you put in your balance sheet? I'm saying initially, meaning when you've just bought it, or when you've just acquired it, or when you've just constructed it, you add all the cost, including transaction cost. When you talk about transaction cost, those costs that are associated to buy that asset. It could be finance cost. It could be these people at architectural fees. All those costs that that are associated to build that asset, whether it's consultants, you engage someone to do a consultancy when you are building the building, the engineering, you add them together, they form part of that cost. That's what you initially put in your books of account as this is a total cost. Now, if an investment property is classified as held for sale, then IFRS 5 applies. We're saying, if now, after that investment property now has been built, we even know that, okay, this property has been built for 1 million, of which now you recognize it as an investment property in your books of account, in your statement of financial position. And now you classify that this is going to be sold. Now it ceases to be accounted for under IAS 40. It now moves to IFRS 5. IFRS 5 is properties held for sale. Now, there are conditions for you to move a property from being accounted for under IAS 40 to IFRS 5. IFRS 5, you're conditioned that you must be sure that this property is going to be sold within 12 months. You must be sure that the price you've put is competitive, meaning the customers will be willing to buy that asset within this period of time. There should be some marketing arrangement, some programs have been initiated to ensure that the property is sold. Then if all that qualifies, then that property ceases to be accounted for under IAS 40 by now is accounted for under IFRS 5. If the investment property is leased out, then, like I explained, it now falls under IFRS 16. Once the property now has been given out, let me give an example of tanker trucks. Mostly people, you find that these people who own filling station, sometimes they don't have trucks to be transporting their petrols and diesel or this crude oil. So they will normally hire tanker trucks from someone else. They will lease the trucks. So those trucks, the owner of the filling station will be paying rentals to the owner of the trucks. So that's this arrangement. So that filling station will be paying some lease rentals. So once there is such kind of arrangement, a movement of this property, then that property ceases to be accounted for under IAS 40, but it goes to IFRS 16 leases. Leases can be either operating or finance lease. So when you hear the question and saying they built an investment property, blah 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 blah, and now next this asset was leased out. So the moment when it was leased out, then it ceases to be accounted for under IAS 40. In other circumstances, then IAS 16 applies, meaning if it's not held for sale, if it's not leased out, if it cannot be accounted for under investment property, then of course it falls under IAS 16. Now, subsequent measures. We're saying now, in the first year, the total cost of procuring that asset, that investment property was 100 million. Now, you are in the second year. How do you measure? Remember, under IAS 16, we depreciate. When we depreciate an asset, meaning we are trying to derive the economical benefit. We are trying to say from this motor vehicle or from this house, which has been used for this period up to here, meaning the company has used this part, and that's how we depreciate to say no, that's what the economical benefit that the company has derived from that asset. But for investment property, you do not depreciate because the purpose is to sell it. The purpose is for it to gain in value, because when you depreciate, it loses the value. So you can't depreciate an investment property. Instead, use fair value models. Fair value model is the price that would be received to sell an asset or paid to transfer a liability, meaning in that year, you need to ask evaluators. You need to evaluate how much is this house now worth. We built it 100,000. Now this year, how much is it? If it is 150 million, then you need to recognize in your books of account in that second year at 150 million. If, for example, you have got some rabbit somewhere, and then someone says, okay, for me, you need to pay me through a building. You need to transfer a building, meaning you need to transfer the rabbit by a building, or you need to pay me by giving me a property. So the same amount you are going to exchange their ability to that building, then that is the value put in the box of account. A gain or loss arising from the change in fair value should be recognized in the profit or loss for the period. Meaning, if, for example, you built it 100 million and now it is at 150 million, meaning the 50 million should be recognized under income, whereby you debit an asset has increased by 50 million, and then your incomes has also increased by 50 million. Now, these are not incomes. They are different from incomes like cash. That's why you post it under comprehensive income, because that is the value it has gained. Because the cash where you sell, you have 100,000, and the cash where it has gained by the value is not as income as cash. It's different. Now, if it is a loss, for example, you value it now that maybe find that maybe the people who are building the house, you spent 100 million. Now, after evaluating it, the buyer says no, they can only buy at 80 million because the building is not properly done. Then that loss should be posted under profit and loss. Now, if the investment property is a mixed use, the component must be accounted for differently. Meaning, if you built a property and now part of it is being used as an office, part of this is being used as an investment property, then you need to apply both accounting standards. Where you're using as an office, you need to apply IAS 16. Where you're using it an investment property, you need to use it under accounting 40. Meaning, if it is a building whereby you know that maybe one first, second, and third floor will be administration, that one will be that one, then you need to account for separately. Thank you. Now, transfer properties. Now, if an investment property ceases to meet the definition of an investment property, the entity should account it according. I've already explained. So if you built a house with initial that you need to appreciate in value, and then so that you can sell it, and as things change, you enter that house, it becomes owner-occupied. Then it ceases to be investment property. You have to account it under IAS 16. If you built a property and then to lease it out or to give it rentals for rentals, and then it changes, you put your own stock. You open you make it this floor. You'll be selling hardware. The other one it will be a hotel. The other one it will be what and what. Then it ceases to be what? To be investment property, because now you are the one occupied. Now you are the one using it for administration purpose. It goes to IAS 16. If it has been now declared to be used under as for sale, then if it's 5, is it higher as 5 applies. In other circumstances, the property is carried at fair value. Disposal and investment property. Any gain or loss on disposal is different between carrying amount and the net disposal proceed. Remember, we said you built this property at 100 million. You valued it at 150 million. That's what is sitting in your books of account. And then you sell it at 140 million. There's a loss of 10 million or 10 million. Then that's what you post under a loss. Or post as a gain or loss. Okay. So now, to appreciate this, let us now look at a practical exam question. I'll stop sharing this.